Hello and welcome to the presentation on rebooting the economy after the COVID-19 lockdown. We're going to look at the fiscal policy being employed by the UK government and then move into what monetary policy can be used and what has already been used by the Bank of England. So, impact of coronavirus in the UK economy. There's been 311.7 thousand confirmed cases, of which 43.6 thousand have sadly died. We've got the fifth highest in the world. GDP has decreased by 20.4% in April, looking on month comparison. Unemployment rate is kept 3.9%, which is fairly consistent, and that's thanks to the furlough scheme. The claimant count has risen to 2.8 million, which is 1.2 million higher than the heights of the great financial crisis, and inflation has decreased to 0.5%. Okay, so fiscal policy to help aid the UK economy. So the government have employed a furlough scheme, which I mentioned previously. They've employed a self-employment income grant. They've introduced VAT tax breaks for businesses. There's a universal credit system. Obviously, it's not a specific COVID-19 policy, however, especially important for part-time workers or individuals who cannot join the furlough scheme. So we could say that at the moment the fiscal policy is used to help stabilise the economy under lockdown. And Syed Jawed in 2010 found that they work well in harmonisation. However, monetary policy should be the focus of helping the economy grow. Now, moving on to monetary policy, inflation rate is currently at 0.5%, which is 1.5% below the UK target rate. This is due to lower consumption and investments. As we can see in May this year, that spending is down by 19.9% compared to last year. So to encourage consumption and investment, so we have decreased the base rate to 0.1%. However, sometimes interest rate approaching 0% may result in banks struggling to pass the base rate onto their deposit facilities, as lower interest rate on deposit facilities mean less people deposit money. Therefore, they could have problems meeting the capital adequacy ratio, and because they've got a higher deposit facility, that means it won't pass on to. It means that there'll be higher loan interest rates. To counter this, Bank of England have introduced a term funding scheme to allow a 4-year loan close to the base rate. This helps the change transmission and money creation. The way that Bank of England reduces interest rate is through the floor system, which is different to the ECB, who use the corridor system. This is done through supplying excess reserves to the market, therefore suppressing the SONIA market, sterling overnight index average, as banks don't need to go to the interbank lending market to require extra reserves to meet the adequacy ratio. As we can see, this has worked successfully, as we can see that the SONIA over the past 10 years since it was implemented has stayed pretty constant with minimal fluctuation. Another monetary policy employed is the asset purchasing programme. Since March, Bank of England have contributed 300 billion to the APP programme. One way these work, they can increase the demand for securitized debt, therefore increasing the price. This increase in price means banks have an incentive to increase the supply of loans, as they can securitize these collateralized debts, such as mortgages, and sell them on. So turning an illiquid asset into a liquid asset. Thus, they can increase their reserves and also their money creation opportunities. Another way this helps is that if they purchase gilts, this can increase the price of gilts and compress yields of the gilts. Thus, this may incentivize investors to switch from purchasing gilts to purchasing corporate bonds, thus helping increase demand for those, which increases the price for corporate bonds and decreases the interest rate. Thus, corporate businesses can borrow at low rates, thus increasing investment. Also, the decompression of interest rate yields can also help encourage banks to loan out more, thus increasing the supply of loans, thus decreasing the interest rate, thus increased consumption and investment. Also, Bank of England promised to purchase corporate debt of large businesses, thus helping to potentially mean that they don't have to make the difficult decision of having to liquidate assets or make individuals redundant, and thus helping these companies become strong as lockdown is eased. However, on the flip side, there could be problems with increasing the APP to about 100 billion. One reason for this is because that the economy might be recovering a lot faster than people have anticipated, and we could be actually seeing that this V-shaped economic recovery is actually happening sooner than anyone anticipated. If we look at the PMI, the Purchasing Manager Index, which interviews managers from the manufacturing and service sectors, and they interview them about new orders, production, employment, inventory, supply, deliveries, imports, and prices. What we can see is that we're seeing this V-shaped comeback where they're actually feeling positive, especially in the manufacturing sector. We see that managers are feeling very excited about the future, and we can see that there's growth since the previous month as it's just creeping above that 50 mark. So whereas Cardin and Prescott 1977 proposed that inflation has a marginal cost, and if you carry on increasing it, the marginal cost gets higher. And if we are seeing that this economic recovery is going up faster, this APP program could cause unnecessary inflationary pressure. Another negative on APP program is that it can be problematic for pension schemes. As we can see, that further asset purchase program announced in March has actually decreased the yield of gilts of all maturities. But then you've got to look at the trade-off between whether the impact of the pension scheme will be an impact of COVID-19. And you would argue that at the moment, we need all focus on COVID-19 and helping the economy recover and reduce the long-term detrimental impact that it has on the economy. So forward guidance helps banks understand what the central bank intentions are for the future in regards to the monetary policy. Bank of England have applied this, could call it a Delphic forward guidance, where they're using their forecasts of monetary of the economic conditions to suggest that the interest rate is going to stay fairly low and rise to roughly about 0.25 between now and 2023. Jay Campbell found that the Federal Open Market Committee became more specific in their forward guidance 2011, which helped it contribute to a fast recovery of the output. Okay, so I've talked about the fiscal policy employed and also the monetary policy employed during the COVID-19 crisis and how that is affecting the economy in a positive way and helping the UK have an economy which is structurally sound and enable it to thrive in a post-COVID-19 environment. Thank you for listening, and here are my references.